Task 1B, question 2a. Rod Tidwell owns and operates two small businesses. Rod's Races is a car dealership in Kew selling new and used vehicles, and Cleaner Cars is a business in Camberwell cleaning the cars of customers. Both businesses were started in 2011, but Rod has only calculated the firm's profits once since operations began. So, what we should do when we run a business is the correct thing is each reporting period, which can be no longer than 12 months, we should calculate the profit. So as each period goes by, whether it's a month, a quarter, a half year, or a year, we have to calculate the profit each time. What's not the right thing to do is buy a business in 2011 and only calculate the profit once in 7 years or however many years you've been running the business. So we've been asked to explain how Rod has breached an accounting principle. So we've got quite a few principles to choose from. So we need to pick one that he's actually breached by not calculating his profit more frequently. So that's the correct thing to do, profit every period. That is the incorrect thing to do, profit once every few years. So the accounting principle that tells us that he has breached that protocol is the reporting period principle. Let's look at what that means. The definition is the life of the business must be broken into periods of equal length of no longer than 12 months. Now, a lot of people stop there with the definition of reporting period. It's actually got a little bit more to it, and that's kind of important because it actually relates to this question. So the other part of this definition is that at the end of every one of those periods of equal length, the firm must calculate its profit by matching revenues and expenses for that period. So whatever the period is, no matter how long, it can't be longer than 12 months, we're going to get our revenues, match it with expenses, and get net profit. Once another period goes by, we do the same. Another period, the same, and so on. So that can't be any longer than 12 months, so that is clearly how Rod has breached this principle. So let's formulate an answer. First thing we're going to do is I for identify. There's going to be an identify mark here because we have an empty box asking for the accounting principle. And we'll write in reporting period. Next thing we're going to do is define the reporting period principle. So the life of the business must be broken up into periods of equal length of no longer than 12 months. And at the end of each of those periods, we must calculate profit by matching revenues and expenses. The last thing we need to do is relate that theory to this particular case study. So in this case, the owner has breached this principle by not breaking the life of the firm into periods of no more than 12 months. He's spent 7 years before he's calculated it. And secondly, calculating profits at the end of each of those reporting periods. Let's look at our 3 marks. We've got 1 mark for identifying the accounting principle, 1 mark for defining what that principle means, and our last mark for relating that to the case study.